On the morning of May 1st, 1948, a black veteran returned home from World War II with an honorable discharge and a dream. He had fought for his country. He had earned his benefits under the GY Bill, and yet, when he walked into the bank, he was turned away. No mortgage, no loan, no chance. His white neighbor, same rank, same service record, walked out with a government-backed loan and bought a house that his grandchildren still own today. What happened to that black veteran was not an accident. It was policy. It was the deliberate architecture of a government that built wealth for one group of Americans while systematically dismantling it for another. And it happened not once, but through decades of calculated decisions, laws, and programs designed to look neutral while functioning as instruments of exclusion. To understand the scale of what the government did, you have to go back further than the GI Bill. You have to go back to 1933, the same year Roosevelt was confiscating gold from ordinary Americans. That same administration was building the framework of modern home ownership in America. The Homeowners Loan Corporation, the HOLC, was created to stabilize the housing market. It drew maps, detailed, color-coded maps of every major city in the country. Green zones were safe investments, blue zones were still acceptable, yellow zones were declining, red zones were hazardous. And in virtually every city, every neighborhood where black Americans lived was outlined in red. This was redlining. The government did not stumble into this system. Its own appraisers wrote explicitly that the presence of black residents lowered a neighborhood's grade. That was the official rationale. Race was the variable. The Federal Housing Administration then used these maps to decide who received government-backed mortgages. If you lived in a red zone, you were denied. If you tried to move into a green zone, restrictive housing covenants kept you out. These were legal agreements written directly into property deeds, stating that the land could never be sold to black buyers. The government did not just tolerate these covenants. Courts enforced them. Until 1948, when the Supreme Court ruled in Shelley v. Kramer that courts could no longer enforce racially restrictive covenants, this system operated with full legal protection. But even after 1948, the FHA continued steering white families toward new suburbs and black families toward declining urban neighborhoods for another 2 decades. The numbers tell the story clearly. Between 1934 and 1962, the federal government backed $120 billion in home loans. Less than 2% went to non-white families. White families used those loans to buy homes in appreciating suburbs. Those homes became the foundation of generational wealth. They were collateral for small business loans. They were inheritance for children and grandchildren. Black families, denied access to this system, were left renting or forced into predatory installment contracts that gave them none of the equity protections of a mortgage. A typical homeowner in a formerly redlined neighborhood has gained $212,023 less in property value over the last 40 years than one in a green-lined area. That is not a coincidence. That is compounding theft across generations. But redlining was only one weapon. At the exact same moment, the government was passing the landmark labor laws of the New Deal era. The National Labor Relations Act of 1935 guaranteed workers the right to organize and bargain collectively. It was a genuine revolution in labor rights, but it explicitly excluded domestic workers and agricultural laborers from its protections. In 1935, the vast majority of black workers in the South were employed in exactly those 2 categories. The exclusion was not accidental. Southern Democrats demanded it as a condition of their support. Roosevelt agreed. And so the law that lifted white working-class Americans into the middle class left black workers outside the door. The Social Security Act of 1935 followed the same logic. Domestic workers and agricultural laborers were again excluded from coverage. This meant that black Americans who spent their entire working lives in those jobs retired with nothing from the federal system that white workers took for granted. They couldn't accumulate retirement savings from Social Security. They couldn't build the financial cushion that allows one generation to help the next. The exclusions were eventually reversed, but the wealth that was not accumulated in those decades was simply gone. There is no recovery for time lost. Then came 1944 and the Servicemen's Readjustment Act, known universally as the GI Bill. On paper, it was race-neutral. Every veteran qualified. In practice, the administration of the bill was handed to state and local officials across the South who simply refused to process black veterans' applications. The Veterans Administration worked with segregated banks that would not issue mortgages in black neighborhoods. The new suburbs being built for returning veterans had explicit racial requirements. Levittown in New York, one of the most famous post-war developments, sold homes only to white families. It was written into the original lease agreements. The federal government financed this. The federal government knew it. And the federal government did nothing. Approximately 1.2 million black veterans served in World War II. The GI Bill represented the single greatest wealth-building opportunity in American history up to that point. Low-cost mortgages, college tuition, business loan guarantees. White veterans used these benefits at scale and built the American middle class. Black veterans were largely excluded. One study found that in Mississippi, of the 3,229 home, farm, and business loans issued through the GI Bill in 1947, only 2 went to black borrowers. 2. In a state where black veterans numbered in the tens of thousands. The effects compounded with terrifying efficiency. A house bought in 1948 for $7,000 in a white suburb was worth $200,000 by 1990. That appreciation funded retirements, college educations, and down payments for the next generation. A black family locked out of that purchase in 1948 did not simply miss a house. They missed an entire chain of economic mobility that extended across the next 70 years. The median wealth of a white household today is $188,200. The median wealth of a black household is $24,100. That gap is not the result of different choices. It is the result of different treatment by the same government that was simultaneously handing white families the tools to build wealth. And while these systems were denying black families access to mainstream wealth building, other government mechanisms were actively destroying what black communities had managed to build on their own. Urban renewal programs of the 1950s and 1960s were officially described as slum clearance. In practice, they were the demolition of black neighborhoods that had developed their own economies, their own business districts, their own institutions. The construction of the federal interstate highway system, funded by the Federal Aid Highway Act of 1956, required routing decisions. In city after city, highways were routed directly through black neighborhoods, not through white neighborhoods, not through industrial zones, through the most established black commercial and residential communities in America. Greenwood in Tulsa, Sweet Auburn in Atlanta, Treme in New Orleans. The government did not just neglect these communities, it bulldozed them. The Fair Housing Act finally arrived in 1968, 35 years after redlining began. By that point, the wealth gap had been structurally locked in. White families held assets, black families did not. A law prohibiting future discrimination could not restore what had already been extracted. And even after 1968, discrimination did not end. It became less explicit. Mortgage lenders who could no longer legally deny black applicants based on race, instead denied them based on neighborhood location, which was still racially coded from the original HOLC maps. Studies conducted in the 1970s and 1980s found that black applicants with identical financial qualifications to white applicants were denied mortgages at significantly higher rates. In 1989, a Federal Reserve study found that black applicants were rejected for home loans more than twice as often as white applicants with equivalent incomes. The banking crisis of 2008 delivered another concentrated blow. Black homeowners who had finally gained access to home ownership in the 1990s and 2000s were disproportionately targeted by subprime lenders. Wells Fargo's own loan officers later testified that they internally called subprime products aimed at black communities ghetto loans. The bank's employees described deliberately steering black borrowers away from conventional mortgages they qualified for and into high-fee, high-risk products. The bank paid $175 million to settle the case, but the homes were already gone. Black home ownership rates fell sharply after 2008 and have not recovered. In 2019, the national black home ownership rate stood at 44%. The white home ownership rate was 73.7%. The cumulative math is staggering. Economists who have studied the racial wealth gap estimate that closing it entirely would require somewhere between $10 trillion and $16 trillion in federal investment. That figure reflects not just present inequality, but the compounded value of what was taken, denied, and destroyed over 4 centuries of policy. Some economists calculate that if Black Americans had received the same access to home ownership programs between 1934 and 1968 as white Americans, the resulting wealth accumulation would have already closed a substantial portion of the gap through inheritance alone. The government built a wealth machine. It ran it for decades, and it ran it for one group. As of 2024, at least 40 localities across the United States have established some form of reparations initiative. 7 states have active processes. Dozens of cities have created task forces or commissions. The amounts discussed at the local level are far below what economists say would be necessary to address the structural gap. A January 2024 national poll found that 70% of Black Americans support reparations. Among white Americans, that number was 26%. Meanwhile, the mean gap in net worth between Black and white households grew from $841,900 in 2019 to $1.15 million in 2022, a 38% increase in just 3 years. The last major federal audit of how these policies affected long-term wealth distribution was never conducted. Perhaps the government that spent decades building this system now believes that naming it is sufficient. But the maps still shape property values. The neighborhoods still bear the economic marks of decisions made in 1935. The inheritance gaps are still widening, and the architecture of exclusion, constructed law by law, program by program, over the better part of a century, has never been seriously dismantled. Whether it ever will be is a question the government has not yet chosen to answer.